We now move on to a very interesting review on financial reporting and analysis called Understanding Cash Flow Statements. This is reading number 26 of the CFA curriculum. So we'll go through a brief introduction of the cash flow statement, understand the three components, namely cash flow from operations, investing, and financing. Understand the very important concepts of free cash flow to firm and free cash flow to equity. Please pay great attention here. And finally, a brief discussion on the various performance ratios involving cash flows. So the cash flow statement, like the income statement, is also periodic in nature. That is, it is defined for 1 quarter or 1 year or one semi-annual period. And it provides information about the financial performance with particular focus to cash receipts and cash outgoes that the company has witnessed during the period. It is categorically separated into operating, investing, and financing activities. So it gives us information about all of these. We studied earlier the concept of accrual accounting that said that both revenues and expenses are not dependent on cash inflows and outflows. Rather, they are more dependent on when the product is delivered and the corresponding expenses. So the cash flow statement will now tell us that what is the impact on the cash inflows and outflows because of these policies. So is the cash flow matching the revenues, or are there too many accruals? And are the cash outflows matching the expenses, or are they more or less? So analysis of the cash flow statement helps us determine if the company's regular operations are generating enough cash to meet the day-to-day requirements and to pay off the existing interest and debt payments. It'll also help us determine if we need additional sources of financing, that is, the cash is not enough. And finally, we can make judgment as to whether the firm has enough available cash to capitalize on profitable opportunities and new opportunities as and when they arise. So cash flow from operating activities are cash inflows and outflows from day-to-day activities or the day-to-day operations of the business. So these are transactions that essentially affect a firm's continuing net income. Cash flow from investing activities, as the name suggests, comes from investment operations, that is the inflows or outflows resulting from the acquisition or disposal of long-term assets and investments. Cash flow from financing are the inflows and outflows resulting from transactions that affect a firm's capital structure, that is the firm's debt or equity. So an increase in debt would be a cash inflow from debt. An increase in equity would be a cash inflow from equity, and vice versa. We'll study all of these in great detail in the coming slides. But please remember that the sum of all cash flows, that is the operating plus the investing plus the financing, will give us the change in the cash balance. That is, the ending cash balance minus the beginning cash balance is the sum of these three activities. So if I add the beginning cash balance to the change in the cash balance, I will get the ending cash balance, and this is going to be a very important calculation when we derive the cash flow statement to verify if we have done the calculations correctly or if we have missed out on anything. So if the ending cash balance is not matching with what is reported on the balance sheet, that means we've made a mistake somewhere in the calculation. So let's first take a look at a few operating activities. The most common cash inflow from operating activity would be the cash collected from customers. These are essentially the revenues that the business is generating from its operations or the sale of its product. Corresponding outflows would be cash paid to raw material suppliers, employees, and cash paid for other expenses, that is marketing, sales, general and administrative expense, etc. So these are the expenses to make the product and to market the product, because of which we are getting the inflows in the form of revenues. Another operating inflow would be the interest received on my fixed deposit or on the investments that I've made in a bank, etc. Similarly, dividends received from my equity investments. All of these are recurring in nature. That is, unless something happens, these interest and these dividends should continue coming every year. Please note that any sale or purchase made with the intention of trading, that is, I don't want to hold on to the asset, be it a fixed asset or a small item, will be recorded as a part of operating activity. So if I am a capital goods dealer, that is, I procure large machines and I sell them forward. My intention is never to construct anything with them. I'm just a trader in these machines. Then the sales proceeds from selling those machines would be a cash inflow from operations, and the acquisition of those machines would result in a cash outflow from operations. So anything bought with the intent of trading would result in a cash outflow from operations, and anything sold which was earlier purchased with the intent of trading would result in a cash inflow from operations. Please note that under US GAAP, interest paid is taken as a part of cash outflow from operations. Under IFRS, you can take it either as financing or operations. Unless otherwise specified, we will assume interest paid as a part of operations or a cash outflow from operations. Similarly, taxes paid to the government would also fall under cash outflow from operations. So please remember, these are some examples of operating activities. These activities are assumed to be recurring in nature and form a part of the day-to-day business and the continuing net income of the company. Any sale of fixed assets or acquisition of fixed assets would result in a cash inflow and outflow respectively from investing activity. Sale of long-term debt or equity investments that we have made in the past would result in a cash inflow from investments. If we acquire debt securities or if we acquire equity investments, please note this is not raising financing. We are giving somebody else a loan, or we are investing in somebody else's debt to earn the yield, or we are purchasing some equity investments of other companies to generate return, then the acquisition of these debt and equity investments would be a part of cash outflow from investing activities. If we give somebody else a loan, that is also considered to be an investment in the other person, or it will be a cash outflow from investing activities when that loan is paid back to us. Any principal received from the loans that we have made to others, not the interest. The interest on this loan will be a part of operations, as we saw in the previous slide. When we get back the principal from the loan, it will be considered as a cash inflow from the investing activities. So some examples of what constitute investing activities. Financing activities, please remember, affect the capital structure. So if we issue new debt or we raise new debt, it is a cash inflow into the company. If we repay our debt, it is a cash outflow. Please note that interest paid is a cash outflow from operations, as is commonly assumed. That is the assumption in US GAAP. Principal repaid on debt will be a part of cash outflow from financing. If I issue equity, similarly, any proceeds from issuing stock will be a cash inflow. Any retirement of stock or reacquisition of stock will be a cash outflow from financing activities. Dividends paid are also a cash outflow from financing. It is similar to returning the equity or retiring the equity. Non-cash transactions are generally investing and financing activities that do not entail a cash inflow or a cash outflow, and hence are not reported in the cash flow statement. For example, purchasing plant and machinery with financing provided directly by the seller. So I purchased an asset worth $100, but I never paid for this asset. I was simultaneously given a loan by the seller of this plant and machinery to the extent of $100. Please note, this loan is not from a bank or not from an external source. It is the same seller who has sold me the asset and simultaneously given me a loan. So I never had to pay anything. I will repay this obligation over a period in time. At the moment, an asset has come in my books to the tune of $100, and correspondingly a liability has gone up by $100. So this is a non-cash transaction. It will not be recorded in the cash flow statement. Similarly, an exchange of debt for equity, for example, when I exercise my conversion option, so I had debt worth $100, and let's say this debt was convertible into equity. So I exercise that option, so my debt gets extinguished and my equity from whatever level it was will go up by another $100. Again, this transaction does not entail any cash inflow or outflow. You can say there was a debt repayment and simultaneously an equity issuance. So this will again be a non-cash transaction. It will not be represented in the cash flow statement. So guidelines mandate that non-cash transactions that the company has entered into must be disclosed separately in a footnote or in a supplemental schedule so that analysts can make the adjustment accordingly and not include their effects in the cash flow statement, since they never required a cash inflow or an outflow. Now, just for the cash flow from operations, there are two ways of presenting the cash flow from operations. Please note the end result of both methods is the same. The first method is called the direct method, which is more intuitive and easier to understand, but relatively tougher to calculate, as we will see in the examples. So the direct method is presented something like the cash collected from customers, the cash paid to suppliers, normally for raw materials, the cash paid for other operating expenses, SG&A, marketing, employees, etc. Cash paid to debt holders as the interest obligation. Cash paid to government as taxes will be deducted, and the difference will give me my operating cash flow. So quite intuitive, this representation, very easy for the user to understand. However, slightly tougher to calculate, as we will understand. The indirect method is not as intuitive, but is relatively straightforward to calculate. So in the indirect method, we begin with the assumption that net income is cash flow from operations, and we then make adjustments to the net income. So the beginning assumption is that net income is my CFO. However, there are components of the net income that are not operating in nature. For example, if there is a gain on sale of land or the gain on sale of plant and equipment, then that part of the net income is not operating in nature, so that has to be knocked off. So subtract gains or add losses that came from financing or investing cash flows. For example, any gain from sale of land or loss on plant and equipment, etc. So that's the first adjustment we'll make. Then there are components of the net income that do not entail a cash inflow or an outflow. For example, most companies will have an entry called depreciation. As we studied earlier, depreciation is just an allocation of the expense which comes from accrual accounting. The entire expense for acquiring the plant has already been made. So depreciation is non-cash expense. It needs to be added back. So add back all non-cash charges to the income, like depreciation and amortization if it exists, and subtract all non-cash components of revenue. So if any revenue source was just from accrual accounting and I didn't receive the cash, then that also should be knocked off. Finally, we need to make adjustments because of balance sheet operating accounts, because if my operating accounts are changing, it may indicate that either cash has not come or excess cash has been received. So increase in operating asset accounts indicates a use of cash. So if my accounts receivable, for example, that's an operating asset, goes up, it indicates what? That I did not receive cash. Even though I made the sale, a part of the sale is lying as receivables, even though the sales was a part of the net income that we were assuming was CFO. A part of the sales is still sitting in receivables. So if the account receivables goes up, that means cash hasn't come and it will need to be subtracted. So any increase in operating asset accounts like accounts receivable or inventory will be subtracted. Any decrease in accounts receivable or inventory or operating asset accounts will be added back. So if accounts receivable come down, that means not only did I receive this period's sales, but I also received some of my past receivables, or the cash inflow this period was higher than what is there in the net income. We'll understand it better with an example, but remember, increase in operating assets are subtracted, while a decrease in operating assets are added to the cash flows derived from the net income. Similarly, increase in operating liability accounts, for example, accounts payable. So if payables go up, that means I haven't yet paid my suppliers, even though I may be showing an expense. So I'm declaring an expense because of accrual accounting, but I haven't yet paid. It's a cash inflow or it increases my cash. So increase in a liability account will be added to the cash flow coming from the net income, while decreases of operating liability accounts, that is if the account payable now goes down, that means not only did I pay my expense for this period, I also paid some of earlier periods payables, hence more cash was used up, or decreases in operating liabilities will be subtracted from the cash coming from the net income. So we'll understand this much better with the help of an example, but this is the indirect method of presenting the CFO. It'll look something like this. So we'll start with the assumption that net income is the cash flow from operations. And then we make adjustments for whatever is non-cash or non-operating. So we add back the depreciation, some amount of taxes that we didn't pay, we are adding back. Accounts receivable went up, that means we did not receive, hence we are subtracting it. Similarly, increase in asset accounts are subtracted, decrease in asset accounts are added. An increase in liability account is added. So if payable goes up means I haven't yet paid, indicating a cash inflow, and an increase in a liability will be added to get to my operating cash flow. Please note, both the direct and the indirect method will give us the same end result. It's just the presentation format that's a little different. The indirect method is not as intuitive for the user to look at. The direct method, as we'll recall, was more intuitive for the user, and we'll see the calculation very soon. So let's understand the concept with an example. We are given the income statement for a company for 2012. That is the sales, cost of goods sold, wages, total expenses, pre-tax income, taxes, net income, dividends are mentioned. We are also provided with the balance sheet, that is the current assets for 2011 and 12, the non-current assets, goodwill, and the total assets. We're given the liability side as well, current liabilities, non-current liabilities, shareholders' equity, and the total liability that matches the total assets. We are required to present the cash flow statement given the income statement and the balance sheet using the direct method of representing the cash flow from operations first. So let's try to derive the cash flow from operations using the direct method. Please recall, the direct method presentation looks straightforward, something like the cash collected from customers and the cash paid to the individual suppliers for operating expenses, interest, taxes, and the difference of the two giving me the operating cash flow. So we'll start by taking a look at the income statement and identifying that the sales of the company for 2012 were $55,000. So if no other information is given, what would I assume to be the cash received from customers? I will assume that these sales came to me as cash, or $55,000. Anything else in the income statement that gives me any information about the cash received from customers from my day-to-day operations? These are all expenses, taxes, net income. So I'll move on to the balance sheet. On the assets side, do I get any information about the cash received from customers? Please note that when making the cash flow statement, do not look at the absolute cash on the balance sheet. This has to be the resultant figure. So whatever we do, the cash flow from operations plus investments plus financing should come out to be a number equal to 9,400. That is the difference between the cash in 2011 and 2012. So if the answer is any different, or the ending cash balance does not come out to be this from our cash flow statement, that means we've made a mistake. The accounts receivable, the next item we see, has gone up from 12,000 to 2,500. It means that another $2,500 of sales has not come in the form of cash or is pending with customers. So from the cash received from customers, I need to knock off $2,500 as the increase in accounts receivables. That is, the total cash received from customers actually was only $52,500. Let's see if there is anything else that impacts the cash received from customers. Inventory doesn't change that. Non-current assets will mainly affect investing activity. And on the liability side, accounts payable, wages payable are all expense accounts. Bonds, equity will affect cash flow from financing. So I think we've understood that the cash received from customers was to the tune of $52,500. The next item would be the cash paid to suppliers. In the absence of other information, we would assume that $20,000, that is the cost of goods sold, would have been paid to suppliers for making the product, or it will be a number of $20,000. But before we conclude, let's look at the balance sheet to see if there is anything that needs to be added or subtracted. So on the assets side, let's start checking the items that we have already accounted for so that we don't have to look at them again. So accounts receivable has already been incorporated into the cash flow statement. The next item we see on the asset side is that the inventory has gone down from $6,000 to $5,500. Now, does this tell us something? Does it mean that $500 out of that $20,000 was not spent this year? That is, this is last year's inventory that I have drawn upon. So the cash must have been spent last year. I'm just selling the product this year. That is, the total amount was not $20,000. I only must have spent $19,500 as cost of goods sold, since $500 worth of inventory has been drawn down. So that's how I'll incorporate the inventory changes into my cash flow calculation. The other assets are non-current assets. They will affect investing activity, not the operating activity. And let's see if the liability side of the balance sheet tells me anything new. So here I see that my accounts payable have gone down by $5,500. That is from $9,000. They've come down to $3,500. So what this implies is that not only did I pay this year's dues, I also repaid my earlier outstandings or earlier payables to the extent of an additional $5,500. That is, the total cash paid to suppliers has to be increased by $5,500, by which my receivables, or rather my payables, have come down in this year. So we'll subtract $500 as the decrease in inventory. So the cash spent was not $20,000, it was only $19,500. But we'll need to add back $5,500 that we have additionally spent as the decrease in accounts payable. So the total cash paid to suppliers would be $25,000. The next item in the direct format of the cash flow statement is cash paid for other expenses. In this case, the other expenses are mainly wages. So, given no other information, we will assume that we paid $3,500 as wages to our employees, and that's the only other expense that is mentioned in the income statement for 2012. Let's see if the balance sheet tells us anything new. So we've already covered all asset accounts. and the non-current assets don't matter for the cash flow from operations. On the liability side, we've already taken care of accounts payable, so let's check that. We see that wages payable have gone up by $3,500. So what this implies is that we did not pay $3,500 worth of wages, which is why the wages payable have gone up. So the cash paid for other expenses has to be decreased to this extent, that is the increase in wages payable to the extent of $3,500, or the actual cash paid for other expenses was 0. Because we were supposed to pay $3,500 but we didn't pay anything, that's why the entire wages payable went up by $3,500. Next is the cash paid for interest. The interest expense is given to be $850, so we will assume that we paid $850 in interest. The asset side has already been considered. On the liability side, we've already checked wages payable. We see that the interest payable has remained flat. That means whatever was due this year has been paid, no more, no less. So we'll check interest payable and we'll keep the cash paid for interest as $850. Tax is also an operating expense, so cash paid for tax comes next, and we see that provision for taxes is what will normally be assumed as taxes paid. So given no other information, we'll say that cash paid for tax is $10,000. However, we see that taxes payable have gone down by $2,000. That means we additionally paid $2,000 worth of past taxes due, or the taxes paid would go up by $2,000. However, there's one more item on the liabilities side that we think does affect taxes, that is the deferred tax liability, that has gone up from $8,000 to $11,200. We'll study how this liability comes and gets extinguished in more detail in the review on income taxes. But remember that deferred tax liability for the moment or for the cash flow statement can be thought of in the same manner as taxes payable. So this liability has gone by $3,200. That means we have not paid $3,200 worth of taxes that we are showing on the income statement. So additional $2,000 because of the taxes payable going down, but less $3,200 because of the deferred tax liability going up. So the cash paid for taxes would be $10,000 plus another $2,000 as the decrease in taxes payable, minus $3,200 to account for the increase in deferred tax liability, which will give us the actual cash paid for tax as $8,800. So if we subtract all the expenses from our cash received from customers, we would get the cash flow from operations. So that will be 52,500 minus 25,000 minus 0 minus 850 minus 8,800. So that comes out to be 52,500 minus 25,000 minus 850 minus 8,800 as $17,850. We will next corroborate this calculation with the indirect method for presenting CFO and verify that the cash flow from operations comes out to be the same from both methods as we discussed. So please recall that in the indirect method, we assume that the net income is cash flow from operations, but we know that it actually is not, and we have to make some adjustments for items that are in the income statement but are not operating in nature. Secondly, items that are in the income statement but are not cash, for example depreciation and amortization. And then we adjust for working capital changes, that is changes to current assets and current liabilities. So in the same example, we'll start with the income statement, and we see that the net income is $27,650. So to begin with, we'll assume that this is the cash flow from operations. However, we see that this income statement has an $8,000 contribution from a gain on sale of land. Even if this gain came in as cash, it is not an operating activity. Sale of land would be an inflow from investments. So this net income has $8,000 contributed from this gain, which needs to be knocked off. So we reduce the additional gain on sale of land and make an adjustment of minus $8,000. We also see that the income statement has a depreciation expense of $1,000. Please note that this expense is not a cash expense. It is just the allocation of the fixed cost of an asset, and the cash for this fixed cost must have been spent in the period that we acquired the asset. This depreciation is now just an allocation that comes because of accrual accounting. It is not a cash expense. So we are reducing the net income by $1,000. It is not a cash expense, so we will need to add back the depreciation to get to the cash flow from operations. So we add back $1,000 of the depreciation, and that is the adjustments that we can see that need to be made from the income statement directly if we start with the assumption that net income is cash flow from operations. We next need to make adjustments for working capital changes. So please remember that an increase in current assets represents an outflow of cash, and a decrease in current assets is an inflow. So let's understand. If accounts receivable goes up from 12,000 to 14,500 as we studied earlier, it means that 2,500 of the sales did not come in or did not come as cash. That's why receivables have gone up. So $2,500 need to be subtracted. If inventory goes down from 6,000 to 5,500, that means $500 worth of previous year's assets have been sold in this period. So the expense would have been recognized, but it was already made in 2011. So in 2012, cash expenses were lower to the extent of $500. Please note that when calculating the cash flow statement, the cash is an ending balance. Do not include changes in cash in the calculation. So from the assets side, we need to deduct $2,000 from our previous calculation as changes in current assets. Non-current assets will affect investing activities. Similarly, on the liabilities side, remember that an increase in current liability is a cash inflow, and vice versa, that is a decrease in current liability is an outflow. Let's understand. So if accounts payable goes down from 9,000 to 3,500 or by 5,500, that means not only did we pay for this period's raw materials, we also paid our outstanding dues in 2012. So in 2012, we spent an additional $5,500 that will reduce my cash, or a decrease in a liability or a current liability is an outflow. Wages payable went up by $3,500. That means I did not pay $3,500 of cash that I'm representing as an expense in the income statement, or my cash will go up to this extent because it wasn't paid. Taxes payable came down by $2,000. That is, not only did I pay the taxes for this period, I also paid another $2,000 of tax due from previous years. deferred tax liability, as we understood, going up means we did not pay tax. Our liability of tax has gone up to the tune of 3,200. So from the liability side, we see that we need to make a total adjustment of minus 5,500 plus 3,500 minus 2,000 plus 3,200. That is a net figure of minus $800. Please note that dividends payable and other items of the liability side will affect cash flow from financing, not operations. So if we sum the various adjustments, $800 negative from the liability side, $2,000 negative from the asset side, change in assets is a $2,000 negative, change in liabilities is a $800 negative. We will get the cash flow from operations as 27650 minus 8,000 plus 1,000 minus 2,800 as 17,850. Please note this is the same calculation that we had derived using the direct method, and now we've represented it using the indirect method. So we now move on to understanding cash flow from investments. Investing activities, remember, relate to the acquisition and disposal of fixed assets and investments, and investing cash flows are calculated as the change in the gross asset accounts from investing activities such as property, plant and equipment, intangible assets and investment securities. So what is the cash outflow or the cash paid for a new asset? This can be calculated as the ending gross assets plus the gross cost of old assets sold minus the beginning gross assets. So let's understand this formula with an example. Suppose that we had beginning gross fixed assets in our company in total of $100. The ending gross fixed assets at the end of the period have gone up to $120, and we know that we also sold machinery in this period worth $10 or with a book value of $10 for a price of $20. So compute the cash paid for new asset and subsequently the cash flow from investments. So had we not procured any new asset in this period, let's assume, what would have happened to the gross fixed assets? At the beginning of the year, they were $100 and you sold machinery worth $10. So this $10 would have gone out of your books. That is, had you done nothing, in year 2, the fixed assets would have been $90. However, the fixed assets actually have become $120 at the end of the year. That means, how much worth of assets have you acquired? $30. And that's what this formula also tells us, that the cash paid for the new asset is your ending gross assets plus the cost of old assets sold, that is $10 worth of old asset that we have sold, minus the beginning gross assets that are $100, which will give us $30. So that is the cash paid for new asset. You do not need to remember this formula. Given the data in the question, you would be able to solve it from basic logic as well, like we just did. So this will be a cash outflow from investments. We also sold some machinery, so the cash received from the assets sold, in this case we know that it's an amount of $20 because we received $20 from the sale of the old asset, can also be calculated as the book value of the asset, which is $10, plus the gain or loss on the sale, which is another $10 in our example. So we received $20 from the sale of some old plant and machinery, and we paid $30 for the acquisition of a new plant. So our total cash flow from investments would be minus $30, this is the acquisition, plus $20, these are the proceeds from sale, giving us a total cash flow from investments of minus $10. So let's do this with a more elaborate example. Let's go back to the income statement and the balance sheet that we've been working with for our previous questions. So it's the same income statement. Let's take a look at it again and see that do we get any information about investing activities from this income statement. Sales, expenses are all operating activities. I do see a gain on sale of land worth $8,000. So I'll keep that in mind, that $8,000 have come as a gain from the sale of land, and this pertains to investing activity. We'll look at the balance sheet, and please remember that as far as investments are concerned, most of the information will come from this section, that is the fixed assets or the non-current assets. So let's see what I have here. I see that a non-current asset called land has gone down by $5,000. When will land go down? When we buy more land or when we dispose of the land? It's when we sell our land. And we also saw in the income statement there was a gain on sale of land worth $8,000. So the total cash received from the sale of land can be calculated as $8,000 of the gain plus $5,000, that must be the cost of the land, since after disposal land went down by $5,000. So I would have received $13,000 from the sale of land, $5,000 covering my costs and $8,000 giving the gain on the income statement. I also see that gross plant and equipment has gone up by $20,000, and there is no information about any plant or asset disposal explicitly mentioned in the question or there in the footnotes. So we'll conclude that we purchased equipment worth $20,000, which caused an increase in this gross plant and equipment. So cash paid for acquisition of asset is $20,000, which needs to be subtracted to get to the cash flow from investments. Please note that even if this gross plant and equipment was not given and just the net plant and equipment was given, I could have still deduced the same answer by analyzing that the depreciation in the year was $1,000 as is available in the income statement. So if I had done no acquisition, the net assets would have gone down from $71,000 to the extent of this additional depreciation, that is down to $70,000. However, the net plant and equipment has actually gone up by $20,000. This is possible only if I have acquired additionally worth $20,000. If the gross plant and equipment is given, just see the difference in the gross plant and equipment to see the cash paid for the asset. However, if it's not given, then you can use this analysis to deduce the cash paid from the net plant and equipment as well. So we can derive the total cash flow from investing as $13,000 minus $20,000, that is minus. Nothing on the liability side that tells me about any investing activity. So we see that the cash flow from investment is minus $7,000. The last remaining category is cash flow from financing. So financing cash flows are determined by measuring the cash exchanges occurring between the firm and its suppliers of capital, namely debt holders, or rather broadly speaking, debt holders and equity holders. Now in calculating cash flow from financing, just be careful that interest paid is technically speaking a cash flow to debt holders, but in US GAAP it is included under cash flow from operations, and we said earlier that unless otherwise specified, we will assume interest paid is a cash flow from operations. Under IFRS, both interest paid to debt holders and dividends paid to shareholders can either be classified as operating or financing at the discretion of the management. So if you feel that both of these are repeatable continuous expenses that should be deducted from operations, you can take them as operating cash flow or you can keep them in finance. So the net cash flow from debt holders will be the new borrowings minus the principal amounts repaid. Please recall that interest paid is cash flow from operations. So any new borrowings would be a cash inflow. Any principal repayments will be a cash outflow. Likewise, net cash flow from equity holders would be the new stock issued. This would be an inflow, minus any money spent in repurchasing or reacquiring the shares, and minus the cash dividends paid will give me the net cash flow from equity holders. At the end of cash flow from financing, we will also verify that total cash flow, that is the sum of CFO, CFI and CFF, will equal the change in cash from one balance sheet to the. So let's get back to our question. We first look at the income statement. Let's see if there's any information about cash flow from financing. These are all operating, investing, operating. The company did declare dividends of around $25,000. So common dividends declared are going to reduce or will be a cash outflow from financing. The asset side of the balance sheet was all considered in operating or investing activities. And please remember, the bulk of the information about financing is going to come from the non-current liabilities section. We also see, however, that dividends payable have gone up by 1,500. So not the entire 24,950 was paid out. 500 of these have been kept as payables. That is why the payables have gone up by 500. So the actual dividends paid were only to the tune of $24,450. Bonds outstanding went down by $2,000, implying that we repaid our debt to the tune of $2,000. This will again be a cash outflow, both dividends paid and debt repaid. We issued common stock worth $25,000. So this would represent an inflow from equity holders. So common stock issuance to the tune of $25,000. Please note that retained earnings will not be used in the cash flow from financing calculation. Retained earnings come from net income, which includes operating and investing impacts, which has already been considered. So we can calculate the total cash flow from financing as the money coming in from common stock issuance minus the debt repaid minus the dividends paid as 25,000 minus 24,450 minus 2,000 equaling minus $1,450. So we've calculated all the three cash flows, the cash flow from operations first using two methods, the cash flow from investments and the cash flow from financing. We can sum these three and now verify that the sum should equal the change in cash. This is a solution to the cash flow from financing. And we can depict the total cash flows as from operations $17,850, from investments minus $7,000 and $1,450 going out in financing, giving us the total cash flow of $9,400. And please recall, this is exactly the amount by which cash has gone up in the balance sheet from 2011 to 2012. That is $9,400. Had we made a mistake in the cash flow calculations, these numbers probably would not have matched. We now move on to a very important classification called free cash flow to firm, or FCFF. So FCFF is the cash available to all suppliers of capital. That is the cash generated by the firm before any debt holders or any equity has been paid any money. That is, with this money I can choose to pay my debt holders or pay my equity holders whatever amount may be required. FCFF can also be thought of as the cash generated by the asset agnostic of the capital structure, that is how much debt or how much equity the company has taken. Let's understand an example. So let's say there are two companies, company A and company B, in the same business. Both required $100 of assets to start the business. Company A chose to fund the business entirely through equity, whereas Company B took debt of $50 and put $50 of equity to start off the company. Both assets are the same, the industry is the same, the business practically is the same. So if A generated sales of $100, our guess would be that B also generated sales of $100. Whether you've taken debt or you've not taken debt would not change the quality of your product and the quality of sales. Similarly, the operating expenses for doing the sales would remain the same. Let's assume $50 for each company. For Company A, this would also be the resultant cash flow, assuming all the sales and expenses were cash. But for Company B, there would be an additional expense, or called interest expense, to the tune of $10. Let's say 20% is the interest payable on the debt. So the cash for Company B would be $40. Now, even though Company B is generating lower cash and Company A is generating higher cash, please note that there is no difference in the two assets. So if we compare the total cash flow, we may get the wrong picture. But if we compare the free cash flow to firm, that is the cash available before any debt or equity has been paid, for Company A it will be $50, because this is the cash from sales and I've only met the operating expenses. I haven't paid any debt or any equity. There is no debt, so I will have to pay no debt, but I haven't yet paid my equity holders either. So this is the cash, that is $50 is available that I can pay to my equity holders if I want. Similarly, the free cash flow to firm for Company B would also be $50. This 50 becomes 40 when I pay $10 to my debt holders. But free cash flow to firm, please recall, is calculated as the cash available to all suppliers of capital, that is before any debt or equity is paid. So if I see the free cash flow to firm for Company B will also be 100 minus 50 as 50. So this proves that the two assets have similar performance. Company B has some of the cash eaten away in interest cost, whereas Company A has no interest expense. So if we were to compare the performance of the assets, free cash flow to firm would be a better measure to judge that which asset is producing more cash and which asset is producing less. So how can we compute the free cash flow to firm? If we start with the cash flow from operations, they mainly contain of all operating activities, that is sales, expenses. However, in US GAAP, cash flow from operations would have also additionally deducted the interest expense. So we want to see the cash available before any interest has been paid. So we will add back the interest expense, but if we pay no interest, we will get no associated tax benefit also. So we will multiply it with 1 minus the tax rate to take away the tax benefit. To see a detailed explanation on why we multiply this with 1 minus tax, you can please read the third session on reading number 25, that is understanding the income statements, to get more clarity. So this will be the cash available from operating activities excluding interest. If I subtract the capex, or I subtract the fixed capital investment, that is I add the cash flow from investments, whatever cash is remaining is all available to be paid to my debt holders and equity holders. With the cash that is generated from operations and after funding my investments is all available to be paid to the debt holders and equity holders. So this will be called the free cash flow to firm. In some representations we split CFO in more detail, that is we call it the net income plus the non-cash charges minus the working capital investment, that is the change in working capital that we studied, and we replace the CFO with these three terms to calculate the free cash flow to firm. So this is the first formula. It is the cash flow from operations plus interest into 1 minus the tax minus the fixed capital investment, or the cash spent in acquiring assets. I can split the CFO as net income plus non-cash charges minus the working capital investment, and also depict the formula in this format. So both mean exactly the same thing. Both of these is cash available to both my equity holders and debt holders. Free cash flow to equity is the cash available to equity holders or to common shareholders. So we can start with the free cash flow to firm to compute the free cash flow to equity. So from the free cash flow to firm, first I will pay my interest, but if I pay interest I will also get a tax benefit plus any principal that I have received from the debt holders. So plus any net borrowing. Net borrowing is the principal received minus the principal paid. So if I have repaid the debt, this number will be negative. If I have taken on more debt, this number will be positive. So after I've deducted whatever was to be paid to the debt and added whatever I have received from the debt holders, the resultant cash will be available to equity holders. It can be paid as dividends, or it can be used to repurchase stock, etc. I can expand the free cash flow to firm and write the formula as cash flow from operations minus fixed capital investment plus net borrowing. If you substitute the free cash flow to firm from the previous slide, you will get the exact same formula for the free cash flow to equity. So once you've derived the cash flow statement, you can compute various ratios to understand the performance of the business better, especially in relation to the cash flows. So you do not have to remember these ratios. We'll study more about ratio analysis in the coming review, but we'll just go over the various ratios to give you a brief idea. So the cash flow to revenue ratio measures the amount of operating cash flow generated for each dollar of revenue. The cash return on assets is calculated as the cash flow from operations upon the average total assets. The cash return on equity similarly would be the cash flow from operations upon average total equity. The cash to income ratio is also another interesting ratio, which tells us that is the operating income actually coming in the form of cash flow from operations, or is most of the income getting lost in accounts receivable and other accruals. Debt coverage ratio shows the cash flow from operations on total debt. Interest coverage ratio is the cash flow from operation plus interest plus taxes, that is cash available to pay my interest upon the interest paid. Similar to the EBIT coverage ratio that we'll study in the next review. Reinvestment ratio is the cash flow from operations upon the cash invested in long-term assets. Debt payment ratio is the CFO upon long-term debt repayment. Dividend payment ratio is the cash flow from operations upon the dividends paid. Investing and financing ratio tells me the cash flow from operations as against the cash outflow from investing and financing activities. So again, you don't have to remember these ratios, but just be aware that cash flows need to be analyzed as extensively as the income statement and balance sheet items. So with this, we've completed a very important review. We've now studied all three statements, that is the income statement, balance sheet, and cash flow statement. Please practice and revise the concepts as usual, and in the coming reviews we'll study more about financial analysis and accounting techniques. Thank you so much. See you next time.